Hello, hi guys. This is here Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. Now, from the today's class, we'll be discussing question and answers from auditing. As you already know, I have launched question bank for CA final audit exclusively for November 2023 examinations. From that question bank, we'll be discussing the questions, and I'll be trying to discuss these question and answers in as much as lower time as possible, so that you can watch these question and answer revision videos as much as many times as possible. Hope that is clear. I'll try to upload question and answers for almost all the chapters, and in case if you want to purchase the question bank and audit concise, the content book which we have launched, you can buy these two books from the link that I will be providing in the description. Hope this is clear. Now, without any waste of time, let us start question and answer discussion. First question. Firstly, we'll be starting with the chapter audit of consolidated financial statements, and obviously from this chapter you'll be getting at least 5 marks. So starting with the first question, write a short note on responsibility of holding company for preparation of consolidated financial statements. Obviously, it is a responsibility of holding company to prepare consolidated financial statements. While preparing the consolidated financial statements, what are various responsibilities that holding company must keep in mind? First of all, to prepare consolidated financial statements, it must identify what are the various components that it is having, that is various subsidiaries in which it has invested. So the first step or the first responsibility would be to identify various components that has to be included in the consolidated financial statements. Once the components has been identified, the parent company, it must gather financial information from those components. That would be the another responsibility. See, obtaining accurate and complete financial information from the components, and after obtaining financial information from the components, the parent entity should, where appropriate, identify reportable segments. Basically, that is the concept of segment reporting. This segment reporting is applicable even in case of consolidated financial statements. So for the purpose of segment reporting, the parent entity, it is the responsibility of the parent entity to identify various reportable segments. And also there is concept of related party transactions. It is also responsibility of the parent entity to identify various related parties and the related party transactions that has been entered with with those related parties. So even that is also another responsibility, identifying related party related parties and related party transactions for reporting. That means in the consolidated financial statements, segment reporting should be done, and also related party transactions should be disclosed. Next, making appropriate consolidation adjustments. There will be two types of consolidation adjustments. One is permanent consolidation adjustments, and another one is current period consolidation adjustments. There are two separate questions with respect to these two types of adjustments that we'll discuss. Next, harmonization of accounting policies and accounting framework. If component is following a different accounting framework or different accounting policies, those accounting policies must be harmonized with the accounting policies that are being followed by the parent entity. Okay, the consolidated financial statements must be prepared based on the accounting policies that are being followed by the parent entity. And finally, gap conversion. In case the components are following different generally accepted accounting principles, those financial statements of component must be converted to the gap that is being followed by the parent entity. So these are the 7 responsibilities of parent entity with respect to preparation of a consolidated financial statements. Hope that is clear. Moving to the second question. You have been appointed to audit consolidated financial statements of Xerna Limited, okay, for the financial year 22-23. While watching, you observed that intra-group transactions have not been eliminated. While preparing the consolidated financial statements, intra-group transactions have not been eliminated. This has been identified by the auditor. Now, you are therefore required to guide the management by explaining what are current period adjustments and list out the same. Now, you need to explain to the management what are current period consolidation adjustments and list out those current period consolidation adjustments. First of all, current period consolidation adjustments are those adjustments which are made in the accounting period for which audit or for which the consolidated financial statements are being prepared. These current period consolidation adjustments, they will be made for every accounting period, whereas permanent consolidation adjustments, they will be made only in one occasion, that is at the time of acquisition of the subsidiary. You will make that permanent consolidation adjustments, but here the current period consolidation adjustments, you will make them each and every accounting year. That is the difference between current period consolidation adjustments and permanent consolidation adjustments. So here you must explain what is a current period consolidation adjustments. See, current period adjustments are those adjustments that are made in the accounting period for which consolidation of financial statements is done. Okay, for each and every accounting period, these current period consolidation adjustments will be made. And current period consolidation adjustments primarily relate to elimination of intra-group transactions, because basically in consolidated financial statements, what you will do, you will consolidate financial statements of both parent and subsidiary. Now, while consolidating, during the year there might be some transactions that might have been taken place between parent and subsidiary. Okay, parent might have sold some goods and purchase, might have sold goods to the subsidiary. Now, this is intra-group transaction. While consolidating these two financial statements, you have to eliminate the sale transaction from the parent and the purchase transaction from the subsidiary. So, these intra-group transactions must be eliminated. This will be coming under current period consolidation adjustments. Like this, there are various current period consolidation adjustments that we'll discuss. First one, intra-group interest paid and received or management fee. Okay, if at all there is any intra-group interest, that means parent company might have borrowed loan from subsidiary, so it might have paid interest to subsidiary. This becomes intra-group interest paid, which has to be eliminated. In case any intra-group management fee that has been paid, even that has to be eliminated while preparing consolidated financial statements. Okay, the entry will not be passed in the books of accounts. There will be memorandum books. Okay, in that memorandum books, just for the purpose of preparing these consolidated financial statements, those adjustments will be made. Okay, the books of accounts of these entities, they will not be altered. Okay, in the memorandum books for consolidation purpose, these adjustments will be made. Hope that is clear. Next, another adjustment, unrealized intragroup profits on assets acquired, transferred from or to the other subsidiaries. In case any assets have been transferred during the year between parent and subsidiary or the subsidiaries, in that case there might be some unrealized profit. Okay, if the asset has been sold at a profit, then for the purpose of consolidation, that unrealized profit must be eliminated. Hope that is clear. In case there is loss, even that loss should also be eliminated. Okay, if at all there is any unrealized profit, that has to be eliminated. In case if there is any unrealized loss on sale of that asset, even that has to be eliminated. Next, record deferred taxes on unrealized intercompany profits. Obviously, if you eliminate the intercompany profits, some deferred taxes might arise. Regarding that deferred tax, you should pass the entry in the consolidated financial statements. Regarding this deferred tax only, there is also another adjustment. If you see here, adjustment of deferred tax on account of temporary differences arising out of elimination of profit or losses resulting from intragroup transactions and undistributed profits. Okay, in case any new deferred tax arise, that has to be recognized in the consolidated financial statement as per third adjustment. And in case any alteration arises for the existing deferred tax, then that has to be adjusted. Okay, these two adjustments related to deferred tax. Next, intragroup indebtedness. If at all there is any intragroup indebtedness, even that has to be eliminated for the purpose of consolidated financial statements. Next, with respect to accounting policies, adjustment related to harmonizing the different accounting policies that are being followed by parent and the components. If at all there is different accounting policy that is being followed, then you have to harmonize it. That means the components accounting policies should be converted to the accounting policy of the parent for the purpose of preparing consolidated financial statements. In the same way, you'll also have another adjustment similar to that of accounting policies. In case of foreign subsidiaries, they might be preparing the financial statements as per their respective gap, as per their respective foreign gap. In that case, for the purpose of consolidated financial statements, you have to convert the financial statements of the foreign subsidiary into the local gap. Okay, even those adjustments with respect to conversion of gap will be falling under current period consolidation adjustment. Hope that is clear. Next, with respect to subsequent events, adjustment of financial statements for recognized subsequent events or transaction that occur between the balance sheet date and the date of auditor's report on the consolidated financial statements of the group. Basically, these subsequent events, they will be of two types. One is adjusting subsequent event and non-adjusting subsequent events. Non-adjusting subsequent event, you need not adjust them in the financial statements. You should only see these adjusting subsequent events. And the consolidated balance sheet, consolidated profit and loss, they will be prepared as on 31st March, right? And the auditors report on these consolidated balance sheet or consolidated financial statements, they might be given after 31st March, let's say some 30 May. Now, in between these two dates, there might be some subsequent events that might have arisen and which might be adjusting. So the adjustments with respect to these subsequent events will also be coming under current period consolidation adjustments. Okay, in the similar way, with respect to subsequent events only, there is another point. Let me explain you that point. Now, there might be some foreign subsidiaries who might be following calendar year as the financial year. That means in India our financial year is April to March. Just a second. 1st April to 31st March. This is the financial year that we follow in India. Some foreign subsidiaries, they might be following January to December as financial year. Now, in India, the consolidated financial statements, they will also be prepared as on 31st March, right? As on 31st March, consolidated financial statements will be prepared. In consolidated financial statement, you will consolidate the financial statements of subsidiary. Now, the foreign subsidiary has prepared the financial statement as on 31st December. Now, for preparing the consolidated financial statements, you should also consider the transactions that has taken place between these two periods for that foreign subsidiary. Okay, even this adjustment with respect to foreign subsidiary will also be coming under current period consolidation adjustments. Hope that is clear. Finally, we have determination of movement in equity attributable to minority interest. All these 10 adjustments will be coming under current period consolidation adjustments. Next, question number 3. The adjustments required for preparation of consolidated financial statements are made in memorandum records kept for the purpose by the parent. Yes. Now, the auditor should review the memorandum records to verify the adjustment entries made in the preparation of consolidated financial statements. Elucidate the other points. Apart from reviewing memorandum records, the auditor should verify while consolidation of adjustments for current period. Now, basically, the current period consolidation adjustments, they will be made by the parent entity. The auditor's duty is to verify those adjustments. Now, while verifying those adjustments, apart from considering the memorandum books of accounts, what are the additional points of verification that has to be kept in mind by the auditor? What are the additional verification points that has to be verified by the auditor while verifying the current period consolidation adjustments? First of all, auditor need to consider whether intra-group transactions have been eliminated. This is the first point that auditor needs to check while verifying current period consolidation adjustments. After that, whether financial statements, the consolidated financial statements have been prepared using uniform accounting policies for the like transactions. Okay, the transactions of parent and the transactions of components, they must be consolidated based on uniform accounting policies. Next, adequate disclosures have been made in consolidated financial statements of application of different accounting policies if it was impracticable to harmonize. First of all, you need to ask the management to harmonize the accounting policies of both component as well as the parent for the purpose of preparation of consolidated financial statements. In case it is impracticable to harmonize the accounting policy, then the same has to be disclosed. Okay. Next, adjustments made to harmonize the different accounting policies, including adjustments made by the management to convert a component's financial statements prepared under components gap to the gap under which the consolidated financial statements are prepared. That is gap conversion in case of foreign subsidiaries. And calculation of minority interest. Even for calculation of minority interest, the auditor must pay attention while verifying these current period consolidation adjustments. Here, in this question, basically, you can rewrite all the points of that current period consolidation adjustments only. Next, adjustment related to deferred tax. Okay. Next, income and expense of subsidiary are included in consolidated financial statements from the date it gains control until the date when the entity seizes the control. See, you need to include the incomes and expenses of the subsidiary only from the date on which the parent has acquired control over that subsidiary. Okay, only from that date you need to include the transactions in the consolidated financial statements. Even this point has to be verified by the auditor whether the incomes and expenses have been properly included in the consolidated financial statements based on the date of acquisition of control. So these are certain important points that has to be considered by the auditor while verifying current period consolidation adjustments. Next question. Write a short note on permanent consolidation adjustments. First of all, what are these permanent consolidation adjustments? Permanent consolidation adjustments are those adjustments that you will make at the time of acquisition of interest in the subsidiary. Okay, you will make these permanent consolidation adjustments only single time. Also in future, after acquiring control over the subsidiary, in case in future, if at all there is any additional interest that to acquire in the subsidiary, even at the time also you will make this permanent consolidation adjustment. And what will be included in these permanent consolidation adjustments? There will be three items: goodwill, capital reserve, and this minority interest. These three items, the calculation of these three items will be coming under permanent consolidation adjustments. The same you can find here: goodwill, capital reserve, amount of equity attributable to minority interest, and verification points. With regard to permanent consolidation adjustments, what are the points of verification that has to be made by the auditor? First of all, auditor should verify adjustment of goodwill or capital reserve, whether goodwill or capital reserve has been properly calculated or not, and minority interest, whether these three calculations are properly made or not. And for the purpose of calculating these minority interest, the date of investment into the subsidiary plays a crucial role. So that has to be kept in mind by the auditor, the date of investment into the component. Next, examine whether pre-acquisition reserves have been allocated properly between the parent and the minority of the subsidiary. The value of goodwill, the value of capital reserve, and the value of minority interest, they will be dependent based on the allocation of these pre-acquisition reserves. So this point must be carefully verified by the auditor, whether proper allocation has been made or not. And in case after acquiring the interest in the subsidiary, verify the changes that might have taken place in permanent consolidation adjustment on account of subsequent acquisition of shares in the components. So these are the points of verification with respect to permanent consolidation adjustments. Next, question number 5. Let us first of all read the question. MNB Investments Limited is a company having paid up share capital of 1 crore. It has a subsidiary, Investors Fund Management Limited. Major business of MNB Investments Limited is to pool money from the investors on a collective basis and invest this money in various funds. Basically, MNB is a investment company. That is what he wanted to convey. Okay, this company pooled 10 crore from number of clients which represent company shareholders. Okay, now while auditing books of accounts of MNB Investments Limited, CAX observed that whole amount of 10 crores pooled has been invested in shares and debentures of various companies, and profits earned due to appreciation of prices of these shares has been distributed to various shareholders of the company. Okay, now CAX raised an issue while auditing financial statements of MNB Investments Limited, whether the consolidated financial statements are required as per section 129 subsection 3 of Companies Act 2013. Analyze the above issue and give your opinion. Now MNB Investments Limited is a investment company, and it has pooled the amount from the investors and it has invested in various company. Now whether this MNB Investments Limited has to prepare consolidated financial statements or not, the answer is basically, if MNB is following Ind AS, then as per Ind AS 110, there is exemption for investment company for preparation of financial for preparation of consolidated financial statements. So if it is following Ind AS, then it need not prepare consolidated financial statements because it is an investment company. On the other hand, if it is following accounting standards, then there is no such exemption for the investment company from preparation of consolidated financial statements. So it has to prepare consolidated financial statements if it is following normal accounting standards. The same you have to write here. So first of all, as per Companies Act, section number 129 subsection 3 says that every company, see, where a company has one or more subsidiaries, then it shall, in addition to the financial statements provided under section 129 subsection 2, that is, in addition to the standalone financial statements, it should also prepare consolidated financial statements consolidating its financial statements and the financial statements of a subsidiary. Okay, in case it is having a subsidiary, then apart from its a standalone financial statements, it should also prepare consolidated financial statements. This is what said by section number 129 subsection 3 of Companies Act. After that, as per Ind AS 110, an investment entity shall not consolidate its subsidiaries. Instead, it should value its investment in subsidiary through FVPTL, okay, fair value through profit and loss, as per Ind AS 109. However, parent of investment entity shall consolidate all entities that it controls, including those controlled through an investment entity, a subsidiary, unless the parent itself is an investment entity. What it is saying is, if parent entity is a investment entity, then it need not prepare consolidated financial statement. That is the first point. In case this entity is there, na, parent entity, it is not an investment entity. It is normal, let's say manufacturing entity. Now it is having a subsidiary. Now this subsidiary is an investment entity and it has made various investments in various subsidiaries again. Now here, if parent entity is an investment entity, then it need not prepare consolidated financial statements. But if parent entity is a subsidiary is an investment entity, then parent entity has to prepare consolidated financial statements, consolidating the financial statements of parent, subsidiary, and the subsidiaries of subsidiary. Hope that is clear. The exemption is available only if parent entity is a investment entity, not if the subsidiary is a investment entity. Hope that is clear. Now you might getting a doubt. What is meant by a investment entity? There is a definition for the investment entity. You can call any entity as an investment entity if it obtains funds from the various public and it promises to the public stating that I will be investing these fund in various other companies for the purpose of capital gain or for the purpose of generating income in the form of dividend or interest, and I will be distributing that income that has been generated to all the investors. If this is the objective of any entity, then that entity will become a investment entity. The same you can find it here. And also it should measure and evaluate the performance of substantially all of its investments on a fair value basis. If these three conditions are satisfied, then such entity will become investment entity and it need not prepare consolidated financial statements. And the conclusion is, considering that MNB Investments Limited is an investment entity, it is exempted from the consolidation provisions by virtue of Ind AS 110. Let me check whether they have said whether the MNB is following Ind AS. MNB Limited is a company having paid up share capital 1 crore. Okay. MNB is pool. Okay. Which represents company shareholders while auditing books of accounts. Okay. Okay. What you can do is, here at the end of the answer you can also write the assumption stating that it is assumed that MNB Investment Limited is following Ind AS for the preparation of its financial statements, so it is exempted. In case if you don't write that assumption, you can also write another point stating that if MNB Investments is following accounting standards for preparation of consolidated financial statements, then there is no exemption for preparation of CFS. It has to prepare consolidated financial statements. Hope that is clear. Next question. R Limited owns 51% voting power in S Limited. It, however, holds and discloses all the shares as stock in trade in its accounts. The shares are held exclusively with a view to subsequent disposal in the near future. R Limited represents that while preparing consolidated financial statements, S Limited can be excluded from the consolidated as a statutory auditor. How would you deal? Here, R Limited is owning the shares of S Limited, and the R Limited's intention is to sell those shares in the coming near future. That is, they have been held as stock in trade. Now, whether there is a exemption from preparation of a consolidated financial statements for R Limited. Basically, if R Limited is following accounting standards, then there is a exemption. But if R Limited is following Indian accounting standards, then there is no exemption. Let us see this. As per Accounting Standard 21, consolidated financial statements, there is exemption from preparation of consolidated financial statements if the control is intended to be temporarily, because the shares are acquired and held exclusively with a view to its subsequent disposal in the near future, or subsidiaries operates under severe long-term restrictions which significantly impair its ability to transfer funds to the parent, if any of these two conditions are satisfied. Okay, first one is its intention is to sell them in the near future, or the subsidiary is operating under a severe long term restrictions which impairs its ability to transfer funds to the parent entity. If any of these two conditions is satisfied, then the parent entity, while preparing consolidated financial statements, it need not include that subsidiary in its consolidated financial statements. Hope that is clear. As per accounting standards, the same you can the conclusion you can find here. See, here you need to remember, let me clarify. Yeah, see, first of all, as per index, if you are investment entity, then straight away exempted from consolidated financial statements. Apart from this exemption, there is no exemption available as per index. As per accounting standards, if you have invested in any entity and your intention is to sell those shares in the near future, or there are severe long term fund transfer restrictions, then you need not include that particular subsidiary in the consolidated financial statements. You need to understand the difference. In the first situation, as per Ind AS, there is complete exemption from the preparation of consolidated financial statements itself. But in case of accounting standards, the exemption is not from the preparation of complete consolidated financial statement itself. See, there is A Limited. Now, A Limited is having, let's say, three subsidiaries: subsidiary 1, subsidiary 2, subsidiary 3. Now, here, let's say, for example, subsidiary 2 is operating under severe long-term fund transfer restrictions. In this case, A Limited, in its consolidated financial statements, need not include the subsidiary 2. However, it has to include subsidiary 1 and subsidiary 3. Okay. Here, there is no exemption from the preparation of complete consolidated financial statements. Just this subsidiary need not be included. Okay. If in case A Limited is having only one subsidiary, that is subsidiary 2, okay, it is not having subsidiary 1, it is not having subsidiary 3, and the subsidiary 2, the single subsidiary 2 is operating under severe long term fund transfer restriction. In that case, A Limited need not prepare consolidated financial statements. Hope you are understanding this. And also, as per Companies Act, there is another exemption. As per Companies Act, if you satisfy three conditions, you will be granted exemption from the preparation of consolidated financial statements. First condition, either you are wholly owned or partially owned subsidiary of a parent company, and you communicate to your shareholders that you don't wanted to prepare consolidated financial statements, and none of the shareholders object to your decision of not preparing the consolidated financial statements. And you should also have the proof that you have communicated with all of the shareholders and shareholders have not objected to your decision. This is the first condition. Okay, this first condition has to be satisfied. Along with this first condition, second condition, your entity is not a listed entity or not in the process of listing either in India or out of India. This is the second condition. And the third condition, your ultimate parent entity must prepare consolidated financial statement. If these three conditions are satisfied together, then as per Companies Act, you are exempted from preparation of consolidated financial statements. This is the entire story related to exemption from CFS as per Ind AS Companies Act. Okay. So, with the help of that discussion, you can solve this question. Next, question number 7. Even this is also similar type of question. Let us see. Moon Limited acquires 51% shares of Star Limited during the year ending 31st March 2020. Okay. During the financial year 2021, 20% shares of Star Limited were sold by Moon Limited. Moon Limited, while preparing the financial statements for the year ending 31st March 2020 and 31st March 2021, did not consider the financial statements of Star Limited for consolidation. So, as a statutory auditor, how would you deal with it? Now here you can clearly find that the intention of the Moon Limited is to sell those shares of Star Limited in the near future. In the next year only it has sold them. So if Moon Limited was following accounting standard, then it is correct in its decision of not including this particular Star Limited in the consolidated financial statements. But however, if Moon Limited was following Indian accounting standards, then it is wrong in its decision of not preparing consolidated financial statements. This is the uh, way in which you need to answer this question. Okay. And also you should refer to section number 129 subsection 3 of the Companies Act. Next, question number 8. H Limited is a investment company. Okay, he says it is an investment company preparing its financial statements in accordance with Ind AS. It is following Indian accounting standards. So as of now, till this point, you can conclude that H Limited is exempted from preparation of consolidated financial statements. Let's see. The company obtains funds from various investors and commits its performance for fair return and capital appreciation to its investors during the year under audit. It had been observed that the company had invested 25% in S1 Limited, 50% in S2 Limited, and 60% in S3 Limited of the respective share capitals of the investee companies. Okay. When checking the investment schedule of the company as issued, cropped as to whether there would arise any need to consolidate accounts of such investee company with those of H Limited in accordance with section 129 subsection 3 of the Companies Act 2013, which contains no exclusions from the consolidation. Analyze the issue involved and give your views. Here straight away, since the company is following Indian accounting standards, and it is clearly mentioned that the company is an investment company, you can avail the exemption from preparation of consolidated financial statements. You can go through the answer. Next, question number 9. Question number 9. A Limited holds the ownership of 10% of voting power and control over the composition of board of directors. See, A Limited is holding 10% in the shares of B Limited, and also it is having control over the composition of board of directors. While planning the statutory audit of A Limited, what factors would be considered by you as the statutory auditors of A Limited for the audit of consolidated financial statements prepared under Ind AS? Now, basically, if you see, as per Indian accounting standards, parent entity can have control over the subsidiary not only in the form of acquiring shares, but through various other modes. The parent entity can exercise control over the subsidiary. One of such mode is having control over the board of directors. So in the present case, A Limited is having control over the board of directors of B Limited. In this manner, it is exercising control over B Limited, and in this manner, B Limited has become the component of the A Limited, and so it has to consolidate the financial statements of a subsidiary, the B Limited, while preparing the consolidated financial statements. Since A Limited is exercising control over the board of directors. Now, with this regard, what are the points that has to be considered by the auditor? Let us see. See, 10% voting power and control over the composition of board of directors. In this case, A Limited holds only 10% of voting power but has control over the composition of board of directors. That means A Limited is having power to determine who should be appointed to the board of directors of B Limited. That means the decision making in the B Limited can be done by A Limited with the help of its power to appoint the board of directors. Now, in such a case, A Limited shall be considered as parent entity of B Limited, and therefore it would be consolidated in the B Limited. That conclusion you have to give first of all. After that, what are the points that has to be verified? The author should verify A Limited's management's assessment of having control in B Limited despite having only 10% voting power as per the requirements of Ind AS 110. Okay, how management is assessing? Okay, how management has come to a conclusion that A Limited is having control over B Limited, because if you see, there is only 10% voting share in the B Limited, but management is having power to appoint the board of directors. So because of that reason, management has come to a conclusion that B Limited is a subsidiary. So auditor need to verify this. Okay, how management has made this assessment? How management is believing that they are able to appoint the board of directors? Is there any agreement between them, or has really the management, the A Limited, has appointed any board of directors on the board of this B Limited? That has to be verified by the auditor. Next, there can be various means by which such kind of control can be established. What happened? Just a second. Yes, now the pen is working. Next point, there can be various means by which such kind of control can be established. See, not only through holding shares, or not only through having control over board of directors. A parent entity can exercise control over the subsidiary through various other ways. Just for example, let's say there is A Limited. Now, this company has developed a particular process for manufacturing a particular product. Now, for that process, it has taken a patent. Now there is another small company B Limited, and A Limited has given that particular process to B Limited, and for that B Limited is giving some fees. Now suddenly, if A Limited stops giving this patented process to B Limited, B Limited will not exist because its entire product, its entire sales depends on this process that has been given by the A Limited. So because of this, A Limited is A Limited has entered into an agreement with B Limited, stating that if you wanted this patented process from me, you should do whatever I say. Okay, you should act as per my instructions. So this is the agreement between A Limited and B Limited. So here A Limited is not having any shares in the B Limited, nor A Limited hasn't appointed any board, any persons on its behalf in the board of directors of B Limited. But because of a particular agreement, A Limited has got control over B Limited. So like this, there could be various scenarios in which a particular company can exercise control over the other company. So now the duty of the auditor is to determine whether there are any of such agreements that has been entered by the parent entity which makes the other companies its subsidiaries. So for this purpose, what the auditor can do is he can read minutes of board meetings, minutes of or a shareholder agreement entered into by parent, agreement with B Limited, to which the parent might have provided any technology or know-how enforcement of statute, etc. Okay. By reading the minutes book or any other agreements that has been entered by parent, auditor has to verify whether there are any subsidiaries to the parent. Okay, whether parent is exercising any control over other companies. Next, further the auditor should verify that adjustment warranted by Ind AS 110 have been made wherever required. Okay, for preparation of consolidated financial statements, all the adjustments, permanent consolidation adjustments and current period consolidation adjustments have been properly made. And also related party transactions. Auditor has to verify whether the list of related parties and related party transactions that has been submitted by the management to the auditor is correct or not. Apart from this, still whether there are any other transactions or any other relationships that are existing, and whether these related party transactions have been properly disclosed in the consolidated financial statements. All this the auditor has to verify. Okay, moving to the next question. Question number 10. This question, it is a quite important question, you can say. See, you are appointed as an auditor of Nawab Limited, a listed company which is main supplier to UK building and construction market. Okay, with a turnover of 2.9 billion. The company operates through 11 business units and has nearly 180 branches across the countries. Okay, as an auditor, how will you draft the audit report in case there are 5 scenarios that has been given? You need to give your answer for each of these scenarios. First scenario, when parents auditor is also the auditor of all its components, that means the auditor whom you have appointed for auditing consolidated financial statements is also appointed as auditor of its components. So component auditor is same as that of consolidated financial statements auditor. In that case, how what points to be considered by the auditor while drafting his audit report? Let us see. First of all, the auditor has to report whether principles and procedures for preparation and presentation of consolidated financial statements as laid down in relevant accounting standards have been followed or not. Okay, for the purpose of preparation of consolidated financial statements, whether the relevant policies and procedures have been followed or not, that has to be reported. After that, whether the consolidated financial statements, that is consolidated balance sheet, is showing a true and fair view or not, consolidated profit and loss is showing a true and fair view or not, And in case if there is also consolidated cash flow statement, whether it is showing a true and fair view or not, that has to be reported by the auditor. In case the auditor of consolidated financial statements and the auditor of components is similar, same auditor. Okay, you can find it here. Yeah, balance sheet, as to whether consolidated profit and loss gives true and fair view results of consolidated profit or loss of the group for the period under audit, and where the consolidated financial statements also include cash flow statement, he should also give his opinion on the true and fair view of the cash flows. Next scenario. See, in the first scenario, 2 points. First one, whether consolidated financial statements have been prepared as per the applicable accounting policies and procedures or not. That is the first point. Next, true and fair view, whether the consolidated balance sheet, consolidated P&L, consolidated cash flows are showing true and fair view or not. These 2 points has to be reported. Next situation. When the parent's auditor is not the auditor of all its components. See, the audit here, you need to consider that parent auditor means auditor of consolidated financial statements. Okay. Now, if the auditor of consolidated financial statements is not the auditor of components, in that case, here the principal auditor, that is auditor of consolidated financial statements, is using the work that has been performed by other auditors. In that case, SS 600 will come into the picture. So the first point that has to be uh, kept in mind by the auditor is the requirements of SS 600 has to be complied. Hope that is clear. And the second point would be, uh, as per SA 706, emphasis of matter and other matter paragraph, auditor needs to specify in the other matter paragraph that in the consolidated financial statements, the financials of some components have been included, and those components have not been audited by me. Okay, to which extent I have not audited. Okay, let's say for example, in terms of revenue, the total revenue that has been reported in consolidated financial statements is 100 crores. Of these 100 crores, the revenue of all the components is, let's say, some 50 crores. Now, in the other matter paragraph, auditor needs to specify that revenue to the extent of 50 crores that has been included in the consolidated financial statements has been audited by some other auditor. I have relied on the audit report of that auditor. Okay, this has to be mentioned in the other matter paragraph. Hope that is clear. In terms of revenue, in terms of assets. Okay, to the extent of how much portion of assets that has been included in the consolidated financial statements belongs to such other components which have been audited by some other auditor. These points has to be reported. In the second situation, see, first of all, SA 600, using the work of other auditor, you need to consider the requirements of SA 600. Next, as prescribed by SA 706, emphasis of matter paragraph and other matter paragraph, you need to disclose in the other matter paragraph. Let's read it. In independent auditor's report, if the auditor considers it necessary to make reference to the audit of other auditors, the auditor's report on the consolidated financial statements should disclose clearly the magnitude of portion of financial statements audited by other auditor. In which paragraph you need to disclose? In other matter paragraph. Because whatever the communication with respect to audit, it will be communicated through other matter paragraph, and whatever the communication with respect to financial statements, it will be communicated in emphasis of matter paragraph. Okay, that you will read in SA 706. And also auditor needs to mention that, here you can find it here. See, reference in the report of the auditor on consolidated financial statements to the fact that part of audit of group was made by other auditor is not to be considered as qualification of the opinion, but rather an indication of divided responsibility between the auditors of the parent and its subsidiary. Auditor needs to clearly mentioned that the fact that I am communicating in other matter paragraph should not be understood as qualification of opinion. Okay, it is just mere disclosure of division of responsibility between parent auditor and the component auditor. Okay, that is a second scenario. Next, third scenario: when the components auditor reports on financial statements under accounting framework different than that of parent. Now this mostly happens in case of foreign subsidiaries. The parent entity, it will prepare its financial statements as per the applicable financial reporting framework in India, and the subsidiary in the foreign, it will prepare its financial statements as per the local foreign gap. In that case, auditor of consolidated financial statement, he is having two options. First option is the foreign subsidiary has prepared its financial statements as per some other gap. Now here the first option is the parent entity has to make adjustments to convert this financial statements of subsidiary from the other gap to the Indian gap. Okay, Indian gap, or you can say the accounting principles that are being followed by the parent entity, or you can simply say parents gap. Okay, it needs to make adjustments. Who has to make the adjustments? Not the auditor. Parent entity has to make the adjustment, and this adjustments has to be audited by the auditor. Okay, auditor of consolidated financial statements, whether these adjustments has been properly made or not, the conversion adjustment has been properly made or not. This is the first option. Second option is a foreign subsidiary itself prepare its financial statements as per the group accounting policies. Okay, here the parent will not convert, instead the foreign subsidiary itself will prepare the financial statements as per group accounting policies, and the auditor, the local auditor, will audit these financial statements, and that audit report will be used by our principal auditor, that is auditor of consolidated financial statements. Okay, from these two options, any one option can be chosen. In case the applicable financial reporting framework of parent and the component is different. Hope that is clear. Next scenario: when the components auditor reports under auditing framework that is different than that of the parent. See, in the earlier situation we have discussed about accounting framework. Okay, the entity has prepared its financial statements as per a different accounting framework. Now in the fourth situation we are discussing about auditing framework. In India we will follow standards on auditing, the same in other countries they will follow their own standards on auditing. Now here the subsidiaries financial statements have been audited as per some different auditing standards. In that case, what should be done by the auditor of consolidated financial statements? Here the only option that is available is the financial statements of that subsidiary has to be audited by the Indian auditing standards, and only those audit report which is as per Indian auditing standards has to be used by the parent auditor for the purpose of consolidated financial statements audit. Hope that is clear. That is the only option available. You can read it here. See, when the components auditor report under auditing framework different than that of parent. Normally, audits of financial statements, including consolidated financial statements, are performed under the auditing standards generally accepted in India. But in order to maintain consistency, yeah, sorry, there was a power cut. We were discussing this fourth situation, right? So, in order to maintain consistency of the auditing framework and to enable the parent auditor to rely and refer to the other auditors' report in their audit report on the consolidated financial statements, component financial statements should also be audited under a framework that corresponds to Indian gas, generally accepted auditing standards. The components financial statements should also be audited as per Indian gas in order to that audit report to be used by the auditor of consolidated financial statements. I hope that is clear. Next situation where financial statements of one or more components is not audited. Generally, the financial statements of all the components must be audited. In case the financial statements of any of the components has not been audited, then auditor need to determine what type of opinion he can give on the consolidated financial statements based on SA 706. In SA 706, we can give qualified uh, adverse disclaimer of opinion based on three criteria: materiality, pervasiveness, and whether auditor is able to obtain sufficient appropriate audit evidence or not. Considering these three criteria, we can give any of those three types of opinions as per SS 706. So, in case the financial statements of components has not been audited, then the auditor need to consider the requirements of SA 706. You can find it here. Components not audited. Generally, the financial statements of all components included in the consolidated financial statement should be audited or subject to audit procedures in the context of multinational group audit. Such audits and audit procedures can be performed by the auditor reporting on the consolidated financial statements or by the components auditor. Okay. Where the financial statements of one or more components continue to remain unaudited, the auditor reporting on the CFS, consolidated financial statements, should consider unaudited components in evaluating possible modification to his report on CFS. The evaluation is necessary because the auditor is not able to obtain sufficient appropriate audit evidence in relation to such consolidated amounts or balances. In such cases, auditors should evaluate both qualitative and quantitative factors on the possible effect of such amount remaining unaudited when reporting on the consolidated financial statements using the guidance provided under SA 705. Sorry, I have told you SA 706, I guess, right? SA 705. 706 is a emphasis of matter and other matter paragraph. SA 705 modification to the opinion in the auditor's report. So auditor needs to consider the requirements of SA 705. Next, question number 11. H Limited is a holding company with two subsidiaries, R Company and S Company. Okay, these two are the subsidiaries. The H Company Limited adopts straight line method of depreciation for its assets, whereas S Company Limited follows written down value or diminishing value method. Though our company limited follows a straight line method of depreciation, it does not give effect to component accounting of depreciation in respect of high value assets. Okay, while consolidating the financials of the R Company Limited and S Company Limited with those of H Company Limited, determine the possible issues that you have to ensure for compliance in light of above facts. Basically, there is H Company Limited, which is a parent, and there is R Company Limited, S Company Limited, which are subsidiaries. Now they are saying that parent, that is H Company Limited, is following straight line method, right? straight line method for depreciation, whereas S company limited follows WDV, right? Yeah, S company limited follows WDV. And what about R company limited? R company limited follows SLM only, but it does not give effect to component accounting. R company follows SLM, but it doesn't give effect to component accounting in case of high valued assets. Component accounting means in case of assets whose value is very high, the depreciation for those types of assets has to be provided based on value of each component. Okay, depreciation to be applied for each component of that asset instead of providing depreciation for the entire asset. The depreciation should be provided for each component of that asset. That is component accounting depreciation. Now here, the first situation that the auditor needs to consider is, we have discussed, the consolidated financial statements has to be prepared as per the harmonized accounting policies. That means CFS has to be prepared as per the accounting policies that are being followed by the parent. And in case the subsidiary is following different accounting policy, then it has to be harmonized to that of parent, that we have discussed. Now here you might think that since the method of depreciation of holding company and the subsidiary company is different, we need to charge depreciation of the assets of subsidiary company based on SLM for the purpose of consolidated financial statements. Like this you might think, but it is completely wrong, because the method of depreciation is not an accounting policy, instead it is a accounting estimate. So the subsidiary, it will charge the depreciation for its assets based on the type of asset. It will follow either WDV or SLM. It is a accounting estimate and not a accounting policy. So you need not charge the depreciation of a subsidiary based on SLM for the purpose of consolidated financial statements. That need not be done. That is the first point. And second point, here R limited, it is following SLM. That is completely fine, but it is not following component accounting of depreciation, which is not in compliance with the accounting standards or Ind AS. This you need to mention in your answer. See, first point that you need to highlight is, method of depreciation is an accounting estimate and not an accounting policy as per Ind AS 8. After that, so in the given case, R limited need not charge the depreciation on SLM method. That is the first point. And the second point, however, each part of an item of property, plant and equipment with a cost that is significant in relation to the total cost of item should be depreciated separately under component method of depreciation as per AS10 on property, plant and equipment. Thus, our company limited, though adopting straight line method but does not giving effect to component accounting of depreciation in respect of high value assets, is not in compliance with either Ind AS 16 or accounting standard 10. Both the standards require component method of depreciation. Okay, moving to question number 12. Deluxe Limited holds ownership of 51% of voting power and control over Executive Limited. Holding company have prepared the consolidated financial statements as required by section number 129 of the Companies Act 2013. What will be your objectives as an auditor in the audit of consolidated financial statements? See, what will be the auditor's objective in audit of consolidated financial statements? This is general question. First of all, auditor needs to uh, get a reasonable assurance that consolidated financial statements are showing true and fair view. See, enable himself to express an opinion on true and fair view presented by the consolidated financial statements. Next, satisfy himself that the consolidated financial statements has been prepared as per the applicable financial reporting framework. After that, needs to check the compliance with section number 143 subsection 1. If you remember 140 subsection 1 of Companies Act, there will be certain 6 points. You need to report on those points if at all you find any negative remarks with respect to those points. Okay, you need to report on section 143 subsection 1 only if you find any adverse remarks with respect to those aspects. Those will be like whether the advances made by the company are prejudicial to its interest, and whether any personal expenses have been charged to revenue account, and whether any shares have been allotted for cash during the year. If yes, whether cash has actually been received or not, and whether transactions by mere book entry are prejudicial to the interest of the entity. Like this, you will find some 6 points under section 143 subsection 1. You need to report on those 143 subsection 1 points. In the similar way, you will have section 143 subsection 3. You should also report on section 143 subsection 3, and you should finally check whether preparation of consolidated financial statement is actually required for the entity or not. See, the auditor should validate the requirement of preparation of consolidated financial statements for the entity as per the applicable financial reporting framework. As per the applicable financial reporting framework, whether the entity is actually required to prepare CFS or not, that has to be validated. These are the 5 objectives of the auditor with respect to audit of consolidated financial statements. Next, what is meant by group financial statements? Group financial statement, you can also call it as consolidated financial statement. Due reference to relevant auditing standard SS 600 using the work of other auditors, and issues addressed concerning the audit of group financial statements. First of all, group financial statements, also known as consolidated financial statements, and group financial statements are presented for group entities under the control of parent. That is, in the consolidated financial statements, you will include the financials of parent as well as of subsidiaries. And the respective standards are AS1 as per accounting standards and Ind AS 10 as per Indian accounting standards. Coming to the standard SA 600 using the work of other auditor. Now, in this SA 600, what is the responsibility of the principal auditor or the auditor of parent company, and what is the responsibility of auditor of subsidiary company? Let us see. First of all, the parent auditor, while using the work of the other auditor, he needs to consider the professional competence of the other auditor in case that other auditor is not a member of ICI. Professional competence means whether he is competent to perform that work or not. Next, visit component and examine books of accounts if necessary, and obtain sufficient appropriate audit evidence that the work of other auditor is actually useful for the purposes of the principal auditor. Next, discuss audit procedures that have been applied by that other auditor. You can discuss with the other auditor what audit procedures that the other auditor has applied during his audit, and in case he has found any uh, findings during his audit, you can also discuss those findings. See, consider significant findings of other auditors, and finally review written summary of other auditors procedures. This is the role of principal auditor in case of audit of consolidated financial statements with respect to using the work of that other auditor. Next, what is the role of other auditor? That is auditor of subsidiary company. First of all, other to the timetable. The other auditor, the auditor of subsidiary company, he must other to the timetable. That means he should complete the audit of subsidiary within the prescribed time, because that audit report of the other auditor will be used by the principal auditor for audit of consolidated financial statements. So the subsidiary auditor must comply with the timetable. Next, bringing to the attention of principal auditor, if in case the component auditor finds any significant findings during his audit and compliance with relevant statutory requirements. While performing the audit, the auditor must comply with the statutory requirements and respond to the detailed questionnaire that has been issued by the principal auditor. This is a requirement of SA 600. Next, question number 14. Again, a repeated question. whether the preparation of consolidated financial statements is mandatory. If yes, please elaborate on the requirement under the statute. You need to write section number 129, subsection 3, which says that where a company has one or more subsidiaries, then along with its standalone financial statements under section 129 subsection 2, it should also prepare consolidated financial statements of the parent as well as the subsidiary. And there is an exemption. What is that exemption? Let us see. These 3 points we have already discussed. It is a wholly owned subsidiary. If the to avail exemption from preparation of consolidated financial statements as per Companies Act, the three conditions should be satisfied: wholly owned subsidiary, partially owned subsidiary of another company, and all of its members agree for the company not preparing the consolidated financial statements, and the company is not listed or not in the process of listing, and its ultimate or any intermediate subsidiary prepares consolidated financial statements. Okay, next. Question number 15. CA Vimal is the auditor of Excellent Limited, a parent company which presents consolidated financial statements. The management of Excellent Limited has provided the list of components included in the consolidated financial statements. As an auditor of consolidated financial statements, CA Vimal has to verify that all the components have been included in the consolidated financial statements and review the information provided by the management in identifying the components. State the procedures to be followed by the CA Vimal in respect of completeness of the information. Now, CA Vimal has been given with the list of all the components that has been included in the consolidated financial statements. Now, CA Vimal, he needs to verify whether the list is complete or not. Apart from these components, still are there any components that are missing? Now, for this purpose, what are the audit procedures that the CA Vimal will perform? Firstly, what the CA Vimal will do is he will see the working papers of previous year audit. He will check whether all the components that have been included in the previous year in consolidated financial statements are included in current year also or not. So, firstly, review his working papers of previous years. Next, he will verify what is the assessment procedure of the management, how the management is identifying the components. So what is the procedure that is being followed by the management for identification of various components? He will also understand that. Next, he will make inquiries of management to identify whether there are any leftover subsidiaries that have been not in, leftover components that have not been included in the CFS. So he will make inquiries with the management, and he will review the investment account of the parents as well as the subsidiaries, because by reviewing the investment account, the auditor will come to know whether the entity has invested in any other subsidiaries. Review the joint ventures and joint arrangements as applicable, and review the other arrangements entered into by the parent that have not been included in the consolidated financial statements. Example, I have given that patented process example that you can consider. Next, review the statutory records maintained by the parent. For example, registers under section 186 190 of the Companies Act 2013. You can also review these minutes of board meeting minutes of shareholders and shareholder agreement. All the by reviewing all those, you can identify whether there are any other subsidiaries that have been left over. Identify the changes in the shareholding that might have taken place during the reporting period. In the previous year, it might have been subsidiary, but during the current year, the entity might have sold some of the shares of that company. Because of that, the shareholding might have reduced below 51%. Because of that, the entity not might not have been a subsidiary during the current year. So auditor needs to check whether there has been any sale of shares in the subsidiaries during the year. Okay, next. Question number 16. ALM Associates has been appointed as auditor of Messrs. Harry Limited, which acquired 55% shares in Sam Limited. That means Sam Limited is subsidiary of Harry Limited on 15th October 2022. During the audit of Harry Limited, the auditors found that company have not prepared consolidated financial statements because on the date of acquisition, the fair value of certain assets and liabilities has not been ascertained, which is significant, and are accounted for on estimated basis only. Help ALM Associates in framing opinion paragraph of audit report. Now, what happened here is Harry Limited has acquired Sam Limited. How much portion? 55%. Now here Sam Limited is subsidiary of Harry Limited, no doubt. But here Harry Limited has not prepared consolidated financial statements. Why it has not prepared consolidated financial statements? Because on date of acquisition, fair value of certain assets and liabilities was not known. Due to this reason, the consolidated financial statements has not been prepared. This is the situation. Now here, ALM Associates has been appointed as auditor of Harry Limited for auditing standalone financial statements, not for the purpose of audit of consolidated financial statements. Because here in the question, nowhere it is said that ALM has been appointed as auditor of consolidated financial statements. ALM has been appointed as auditor of Harry Limited for auditing standalone financial statements, and they have found that consolidated financial statements have not been prepared, and now they are asking to help them in framing the opinion in the audit report. Now, if you see here, preparing consolidated financial statements is very much mandatory, and they have not prepared. This point has to be reported in the audit report. But you need to remember that because of this point, you cannot modify the opinion in the standalone financial statements, because standalone financial statements, they are showing true and fair view. Just because of the fact that consolidated financial statements have not been prepared, you cannot modify the opinion in the audit report of standalone financial statements. That must be kept in mind. So you can just report, disclose, saying that the consolidated financial statements has not been prepared in the standalone audit report. You need to disclose this fact. Okay. But in the ICA's suggested answer, they have given that modified opinion has to be given by the auditor in the standalone financial statements audit report, which is completely not possible. Because if auditor has been appointed to audit consolidated financial statements, then in the audit report of consolidated financial statements, you can give the modified opinion. But here consolidated financial statements itself have not been prepared, and in the standalone financial statements audit report, how can you give a modified opinion because of this fact? That is not possible. So here you can say that the question itself is incomplete. So as per the available information, you can say that uh, Sam Limited is subsidiary of Harry Limited, and it is mandatory to prepare consolidated financial statements. But in the current situation, they have not prepared. So consolidation is mandatory, and auditor is required to state the fact. You just need to state the fact in the audit report on standalone financial statements. Okay. Next, question number 17. Before commencing an audit of consolidated financial statements, the auditor should plan his work to enable him to conduct the effective audit in an efficient and a timely manner. What are the important aspects that an auditor should consider in the audit plan? Okay, for planning the audit of consolidated financial statements, what are the considerations that has to be taken by the auditor? First of all, you need to understand the group structure and the controls that have been placed at the group level. After that, you need to understand the accounting policies that have been followed by the parent entity for preparation of consolidated financial statements, and you need to determine the nature, timing, extent of the audit procedures that have to be applied based on the risk of material misstatement that you have determined. Okay, determine nature, timing, extent of audit procedures based on ROMM, risk of material misstatement, and then determine the extent of use of other auditors work, and finally properly coordinate the work with the other auditor. So this way you need to plan the audit of consolidated financial statements. Next, ABC Limited holds 51% equity in Triple B Limited, 63% equity in Triple T Limited, there are different information and explanations which are disclosed by respective companies in the notes to their financial statements. At the time of consolidation, management of ABC Limited has consolidated all the information and explanations disclosed in the notes as well. The principal auditor is of the view that only those information and explanation should form part of notes to consolidated financial statements which are relevant at the group level. Please mention any five aspects which are given in the notes to separate financial statements of the parent and subsidiaries need not be included in the consolidated financial statement. First of all, what is the question? Now, parent, it will prepare its financial statements. In its parent's financial statements, there will be notes to accounts. In these notes to accounts, there will be various disclosures. In the same way, components, they will prepare their own standalone financial statements. There will be notes to accounts, and there will be some disclosures in the notes to accounts of the components financial statements. After that, consolidated financial statements will be prepared. Even in the consolidated financial statements, there will be notes to accounts. Now here what they have done is they have combined the disclosures of parent as well as components. Okay, all the disclosures that have been made in the standalone financial statements of both the entities, they have uh, as it is copied them and pasted them in the notes to accounts of the consolidated financial statements. Whether this approach is correct, the answer is no, because for the consolidated financial statements, you need to make only those disclosures that are relevant at the group level. Okay, you need not disclose those disclosures that are relevant only at the component level or only at the parent level. The disclosures that are relevant at the entire group level should be made in the consolidated financial statements. Now with regard to this, they are asking you certain examples of disclosures that will be made in the standalone financial statements but will not be made in the consolidated financial statements. Okay, give certain five disclosures that will be present in the standalone financial statements but need not be present in the consolidated financial statement. They are asking you five such examples. Let us see. Firstly, source from which bonus shares are issued. If during the year the either the component or the parent, if they have issued any bonus shares, then in their standalone financial statements they need to disclose from which source the bonus share has been given. But such disclosure need not be present in the consolidated financial statement because that issue of bonus share is relevant at the standalone financial statement level. Okay, next, disclosure of unutilized money out of issue indicating the form in which such unutilized funds have been invested. Let's say during the year the parent has raised certain money through IPO, let's say, and it has not utilized the entire amount. There is some unutilized funds. Now it has to be disclosed in the financial statements of the standalone, but such a disclosure need not be given in the consolidated financial statements. Hope that is clear. Next, disclosure required under MSME Act. Basically, as per MSME Act, if you purchase any goods from the MSMEs, micro, small, medium enterprises, and on credit basis you have purchased, in that case, in the notes to accounts, in the creditors section, you need to separately show how much of creditors consist of MSME creditors. Okay, separate disclosure has to be given with respect to the amounts that are due to MSMEs. The disclosure is required only in the standalone financial statement, but such type of disclosure is not required in consolidated financial statements. Hope that is clear. Next, next example, a statement of investments classifying trade investments and other investments, showing the name of body corporates in whose shares or debentures investments have been made. Basically, in the standalone financial statements, with respect to the investments in shares and debentures of other companies, you need to give a list of all the investments, showing in whether you have invested in share or debenture or any other type of security, and in which company you have invested and what is the amount of investment you have made. This list of disclosure is required only in the standalone financial statement, but not in the consolidated financial statement. I hope that is clear. Next, value of imports calculated on CIF basis. CIF means cost, insurance, and freight by company during the financial year in respect of raw material, components, and spare parts and capital goods. That is, you need to disclose in the standalone financial statements what is the value of imports that you have made with respect to raw materials. How much of raw material you have imported? How much of consumables you have imported? How much of capital goods you have imported? This disclosure is required in the standalone financial statements, but not in the consolidated financial statements. Again, with respect to this import only, there is another point. See, value of all imported raw materials, spare parts, and components consumed during the financial year, and the value of all indigenous raw material. Indigenous means those which have been purchased locally within India, spare parts and components similarly consumed, and the percentage of each to the total of the consumption. See, during the year of the total raw materials that you have consumed, how much of that raw material has been imported and how much of that raw material has been purchased within India. That bifurcation is required in the standalone financial statement, but it is not required in the consolidated financial statement. Hope that is clear. Next, coming to the expenditure in foreign currency during the financial year on account of royalty, know-how, professional and consultancy fee, interest, and other matters. You need to separately disclose how much of expenditure you have incurred in the form of know-how, royalty, professional and other consultancy fee outside India. Okay, you have paid in terms of foreign currency. Okay, how much you have paid in terms of foreign currency for these expenses. Again, with respect to these expenses only, there is another disclosure. See here, the amount remitted during the year in foreign currencies on account of dividends with a specific mention. Sorry, not with respect to that, with respect to foreign currency. Yeah, the amount of remittance during the year in foreign currency on account of dividends with a specific mention of number of non-resident shareholders, the number of shares held by them, and on which dividends were due, and the year to which dividends relate. See, with respect to foreign currency expenditure, there are 2 points. First point is how much of foreign currency expenditure you have incurred in the form of know-how, royalty, all that three types of expenditures you have now, professional and consultancy fee. And next one is how much of foreign currency payments you have made for the purpose of dividends to the NRI shareholders. Okay, non-resident shareholders. How much of dividend you have paid them in the foreign currency? Even that disclosure is required in standalone financial statement. Okay, you should also disclose number of shares that have been held by those non-resident shareholders, and on which dividends were due, and to which year that dividend belongs to. This disclosure is required in the standalone financial statements, but it is not required in the consolidated financial statements. In the same way, the previous 2 points related to expenditure in foreign currency, right? Now this point is with respect to earnings in foreign currency. Okay, you need to disclose how much of foreign currency you have earned during the year by way of export of goods, by way of royalty, know-how, professional and consultancy fee, by way of interest and dividend or other income. You need to bifurcate the total foreign currency income that you have earned during the year. You need to bifurcate it into these four categories, and you need to disclose it in the standalone financial statements, but this disclosure, it is not required in the consolidated financial statements. Okay, all these 9 points, they are examples of disclosures that are required in the standalone financial statements but not required in the consolidated financial statements. Hope that is clear. Next, this question with respect to materiality, you can easily go through with that question. It's not a big issue. Next, question number 20. Now this question number 20 is also similar to type of question that we have discussed earlier. Let's just briefly go through this. Rao and Company, a chartered accountant firm, is appointed as principal auditor of listed entity Triumph Limited. Figures of income and net worth of five out of seven components of Triumph Limited, which are its unlisted subsidiaries. Okay, they have given basically Triumph Limited is having seven subsidiaries. Of those seven subsidiaries, the numbers related to five subsidiaries are given here. Okay, what is the income of each of these subsidiaries? What is the net worth of each of these subsidiaries? They have given. Now, with respect to the remaining two components, that is component F and component Z of Triumph Limited, were unaudited. Okay, the components are unaudited. Component F and component G is unaudited. Here you will find this in the fifth scenario. We have discussed in that question. There are five scenarios. Of those five scenarios, this question will fall under fifth scenario. Now, according to Mr. Rao, the engagement partner, component F is material to the consolidated financial statements. Okay, component F is material to the consolidated financial statements, whereas component Z is not material to the consolidated financial statements. Okay, and this fact has also been discussed in writing with those charged with governance of Trimp Limited, and it will also form part of report as key audit matter in accordance with SS 701. What shall be the audit consideration in relation to the reporting in case of unaudited components of Trimp Limited by Rao and Co, and how Rao and Co as a principal auditor should report in case of component F and component Z? First of all, here they are saying that component F and component Z are unaudited. Okay, and component F is material to the consolidated financial statements. If it is very much material to the consolidated financial statements, it must be audited. And in case if it is not audited, auditor needs to consider the type of opinion, the impact that will have on his opinion as per SA 705. Okay, based on that three criteria: materiality, pervasiveness, and sufficient appropriate audit evidence. Based on these criteria, he needs to determine what type of opinion he needs to give, whether qualified, adverse, or disclaimer. Okay, that he needs to determine as per SA 705 with respect to component F. And coming to component Z is also not audited, but they are saying it is immaterial. Since it is immaterial, auditor needs to communicate with respect to this component Z in other matter paragraph. Okay, that is how he can report. Okay, if you find see the, I'll just read the conclusion. Thus, in case of component F, principal auditor needs to consider its impact on the auditor's opinion on consolidated financial statement of the group in terms of SA 705. Okay, with respect to component F, he needs to consider SA 705 modifications to the opinion, whereas with respect to component Z, the principal auditor should make appropriate reporting under other matters paragraph. Okay, as per SA 706. Next question, question number 21. This question, it is related to exemption from preparation of consolidated financial statements. Here you need to refer AS 21. The two criteria is there. If you are holding the shares for sale in the near term future, or there is severe long term fund transfer restrictions that are operating on the subsidiary, then you need not include that particular subsidiary in the consolidated financial statements as per accounting standards. You need to mention that. And as per Ind AS 10, if you are an investment company, you need not prepare consolidated financial statements. This question you can refer. By this, we have completed a discussion of question and answers from Audit of Consolidated Financial Statements chapter. And in the next class, we'll meet with another chapter, and you can purchase this question bank, and you can also purchase audit concise book from the link that I'll provide in the description. And if you want to quickly revise the entire concept of auditing, you can also consider watching our playlist of auditing revision that I have already created. And I'll be winding up this video as of now. Take care. Bye bye. See you.